Good evening and good morning to all of you. I'm Alicia Ogawa. I'm the director of the project on Japanese corporate governance and stewardship at the Columbia Business School. The project was established to reflect the key role that Prime Minister Abe's governance initiatives play in revitalizing the Japanese economy. But our focus has always been on comparing best practices from around the world. Japan is at the beginning of its journey when it comes to good governance and stewardship, and it has a lot to learn from its global peers. But on the other hand, Japan's traditional focus on stakeholders rather than simply shareholders offers a lot for other countries to learn from. So in keeping with that tradition, we're here tonight to compare and contrast how Japan and the United States have reacted to the same concern, the need to put new controls on foreign investment in order to protect national security from leakage of sensitive technology and data. The new rules apply not only to acquisition of whole companies by foreigners, but also to portfolio investment, the purchase of shares of listed companies, even a minority stake. The approaches that Japan and the United States have taken couldn't be more different. As in any policy choice, there are trade-offs, and there's also unintended consequences, some of which we're already beginning to see. We're fortunate enough to have two speakers who are deep in the trenches and dealing with these issues in a very practical, not an abstract way. So I'm very glad that they've decided or they've accepted the invitation to appear tonight. Before I turn the meeting over to them, allow me to sketch out the changes they will be talking about and the issues that I've asked them to address. In Japan, the new amendments to the Foreign Exchange and Foreign Trade Act, or FEFTA, were rolled out in October of 2019. Even my Japanese government friends will admit that the rollout was a bit of a public relations disaster. There were many agencies involved in the new rules, but it seemed like none of them had talked to each other. And no one seemed to have definitive answers to the many questions the new laws raised. It later became obvious that the new rules had been rushed into public announcement due to real or perceived pressure from the US government before consensus had been reached among the ministries involved. And this relationship between the United States and Japan, when it comes to dealing with sensitive technology, national security, and the issues of China, will be a main focus of our discussion. The new rules in Japan expanded the list of industrial sectors that would be considered sensitive to national security. And oddly enough, a list of thousands of publicly traded companies that fall into these sensitive sectors has been published with codes to indicate the level of sensitivity to national security. To me, this seems a bit odd. It's like creating a list for spies that here's where you need to look where national security interests lie. Be that as it may, the new rules also dropped the level of share ownership that would trigger a government review from 10% to 1%, which left many foreign investors howling. An exemption to the government review was offered, but only if foreign investors would refrain from exercising the right to vote their shares on certain types of shareholder proposals. Turning to the US, we've had a Committee on Foreign Investments into the US, or CFIUS, since 1988. Like Japan, it's an interagency process that reviews the national security implications of foreign direct investment into the US. But different from Japan, a potential acquirer does not need to undergo a review prior to purchasing a company, although it can request one if they have a concern that security concerns might be an issue which will impose on the resolution of the transaction. This arises because, unlike Japan, the US does not publish a list identifying specific companies as critical to national security. To date in the United States, 5 transactions have been blocked by CFIUS, but there is no way of knowing how many transactions have been abandoned due to concerns of the ultimate outcome of a CFIUS review. The US is the largest recipient of foreign investment and has therefore tried to adopt a hands-off approach. However, events after September 11th and the rise of state-owned enterprises buying into technology companies created increased concerns. So under the Trump administration, a new law was added in 2018 to CFIUS, which is called the Foreign Investment Risk Review Modernization Act, or Firma. This added new areas of the US economy that could come under review for national security. There are some areas of focus that do not figure as prominently as they do in Japan, namely data, real estate, and private equity. And it's not just Japan and the United States that have erected barriers to foreign investment recently. In Poland, in response to the economic ravages of the COVID pandemic, many companies there experienced sharp plunges in share prices. And the government reacted by essentially banning all foreign acquisitions, since they feared that a bargain basement sweep by foreign investors could result in a wholesale transfer of Polish companies into foreign hands. And in Germany, which has long taken a lenient approach to foreign investment, rules there were tightened in 2017. This summer, an attempted acquisition of a German machinery company by a Chinese acquirer was blocked. And the German government then reduced the threshold for national security review from 25% of total shares to 15% of total shares, and they extended the time the government could take to review such acquisitions before approving them. So the questions we have to discuss tonight are, how are these new rules changing the world, and what are the unintended consequences? The pandemic created a political outcry in many countries, including Japan and the US, to nationalize global supply chains, citing national security concerns. Prime Minister Abe offered low-cost financing to Japanese companies who would agree to move production facilities out of China and back to Japan or in Southeast Asia, but that proved to be impractical or undesirable for many reasons for Japanese companies. So in spite of what politicians would want, none of this seems likely to happen. And therefore, how will companies and their investors adjust? What will these new rules do to corporate governance, since they put conditions on who can vote at shareholder meetings and who can sit on boards? What will the rules do to global asset managers who have to contend with a range of national definitions of what constitutes a foreign investor? What will these new rules do to the future of Silicon Valley, where innovation depends on a free flow of money as well as people? And to put it simply, are we headed towards a world where citizens of a given country are only allowed to invest in the companies headquartered in their own country? And if the common concern is China, is there a better multilateral approach than the situation we have now, where each country is just deciding on their own how to handle these challenges? So here to help us understand this new world is Martin Chorzempa of the Peterson Institute of International Economics, and Mr. Nels Hansen of the Tokyo office of the law firm White & Case. I'd really like to avoid using time here to read you their bios, but I encourage you to look at them online, because you'll understand then why I don't have the time here to list even an abbreviated version of their qualifications and their accomplishments. I've asked each of them to spend a few minutes outlining the new rules, and then we'll enter a discussion of some of the key controversies. So please enter any questions you have as we go along in the Q&A box, and I will do my best to work them into the conversation. So thank you again for tuning in. And now, if I may, I'd like to turn the Zoom box over to Martin.
Thank you, Alicia. I'm excited to be here and talk about some really important issues. I'll first talk a little bit about what CFIUS looked like before Firma. And essentially, as Alicia alluded to earlier, if a foreign investor would get control of a US business through a transaction like a merger or acquisition, then CFIUS would have the authority to review that transaction. And if they have national security concerns with that transaction, they can demand modifications to the deal or even reject it due to national security. An actual rejection requires the president to intervene personally, so the drafters took it quite seriously. The key here is that the requirement is real national security concerns. They explicitly avoided using the term economic security, which they thought would lead to protectionism and trying to stop competition from foreign firms by hijacking the process. It's a largely voluntary process, or at least was before Firma. So a firm will decide on their own whether they will file or not. There was no requirement. A minuscule share of overall M&A deals in the United States ever got reviewed or investigated by CFIUS. So it affected a very small subset of firms. And there's almost nothing disclosed about what firms were involved, partially because the rationales for the decisions are based on secret national security concerns and maybe intelligence reports. And those come to bear on business secrets that are shared in the transaction. So for the process to work, it requires extreme secrecy. The problem then is that people don't really know. There's no public case history, like with most court cases, for example, that would allow you to look at, okay, I have a business transaction. Can I tell just relatively easily as a layman whether I should file with CFIUS? So essentially lawyers in this space are deputized to play this role because they have done transactions before. They've seen what CFIUS has asked about, what they've blocked, and they have a wide body of knowledge which is simply not available to the public. If you don't file with CFIUS and they find later that there were problems with the transaction, they can force you to reverse that transaction. That is immensely costly. But if you file and you get through the process and they decide later, oh, actually we have some concerns with that transaction, you have a safe harbor and they can't reject that deal. So what did Firma do? Firma expanded reviews it did quite a bit actually to expand the power of CFIUS. But most importantly, in my view, is the expansion of reviews to what are non-controlling, non-passive investments in areas like critical technology, critical infrastructure, and sensitive data. And what that means is if you have a portfolio investment where you're going to have a relatively small share in the company, you don't get to nominate anybody to the board or get access to a bunch of material, like technical, detailed information on the company. If you're just going to buy, a couple % of a company, that's fine if it's passive. But this kind of, before there was a perception that there was a loophole in the law where only if they were getting control could the investment be reviewed. And now they're saying the only way you can be totally free from a review if you're in these sensitive areas is if you have no control over the company except for voting your shares. Now, interestingly, there's an exception to this expansion of the review, and that's a whitelist that exempts investors from a few countries from this expansion of the rules, which could be very difficult to comply with, and I'm sure we're going to get into that later. But right now, there are only 3 countries on that list, and even most companies within those countries would not qualify. So this exemption is very small as of now. Another is a mandatory filing requirement in critical technologies and for some transactions involving foreign governments. That means that they have to file. That's become mandatory. And there's been an addition of a large amount of increased resources for CFIUS. CFIUS had not nearly enough people on it to be able to review the body of transactions that they would like. So they received significantly more money to hire more people. And also it increased the interconnection between export controls and CFIUS, where some of the determinations about what technologies will be controlled for export will feed into and cause companies that produce those technologies to be added to more scrutiny on CFIUS. So I will end there and I'm excited to have some Q&A.
Thank you very much, Martin. If I could turn it over to Nels to give the, as I called it, the idiot's guide to FIFTA.
Happy to, Alicia, and thank you for the opportunity to speak to everybody. Good morning, good afternoon, and good evening to you, wherever you may be. So just very briefly, I'm not a Japanese qualified lawyer, but I'm at the law firm White & Case. We do have Japan qualified lawyers who I work with, and the remarks that I'm about to give were reviewed by them in advance. So Japan's Ministry of Finance and its ministries with jurisdiction over the relevant business of a target company, they review foreign direct investments under the Japan's Foreign Exchange and Foreign Trade Act, which we're calling FEFTA. So similar to the US, since the 80s and 90s, as Alicia said, there have been regimes in place and changes made to it with respect to the regulation of foreign investment. Japan had a combined pre-notification system and post-notification system. Now they're called that, but in fact, pre-notification means that for some transactions under FEFTA, you need to file a notice in advance with the government, and either a waiting period needs to expire or they need to effectively approve of your action before you can proceed. And so in effect, it requires prior approval for certain limited transactions. And For other transactions, simply reporting after the fact suffices. So the November 29, 2019 amendment to FEFTA, which I think is what we're all focused on now, that came into force on June 7, 2020. And that's an important date that we'll get into later because Japan's annual shareholder meetings tend to happen towards the end of June. When it came into effect, what it did is it expanded the scope of foreign direct investment review. It lowered the threshold for screening the purchase of listed companies' shares to acquisitions at 1% or more of the target company. Previously, it was at 10%. And it introduced a new prior notification exemption scheme for share acquisitions, meaning that previously there wasn't an exemption regime, but now there is an exemption regime in place. Depending on the type of business in which the target entity is engaged or the nationality of the foreign investor, a prior notification or post-transaction filing will have to be made through the Bank of Japan, and that will then go to the relevant ministries with jurisdiction over the transaction. In practice, this is maybe a 5-page filing in Japanese, and there may need to be some appendices attached, and there may need to be a back and forth with the relevant ministries. There may be conditions that are imposed or requested to be imposed. It can become an involved process, but the initial filing itself is really not too much paperwork when you think about it in comparison with some other countries. Now, the scope of foreign investment was expanded. So acquisitions of shares, that's clearly foreign investment. And the scope of acquisitions, that threshold, as mentioned, was lowered from 10% down to 1%. But in addition to that, a couple of new categories of actions were incorporated into the definition of foreign investment, even though these actions are intuitively not investments. Specifically, a vote in favor of a shareholders meeting proposal to appoint either the investor itself or its closely related persons to the board of directors or to the audit and supervisory board of a target was newly added to the definition. So what that means is that the actual purchase of shares may be a subject transaction, and the voting of the shares that one holds for one's own director, basically director candidates, that is also considered a foreign investment now. And there's also a category related to the proposal to dispose of a business that's in a designated industry. In practice, not that significant because that tends not to be a shareholder proposal. So at a high level, again, the scope was expanded. The level at which you have to make a filing or consider making a filing was dramatically expanded from just 10% or higher acquisitions down to 1% or higher. And also the voting of one's shares is now considered an investment that requires potentially review and approval. So I'll turn back over to Alicia now.
Thank you both. To the audience, I thought it was important to get a professional, as opposed to me, explanation of what the laws actually mean. But now let's skip to the fun part and talk about what this all means and what kind of controversies and as I said, unintended consequences these new laws are creating. So I'll start with Nels. He and I had a short conversation a couple of weeks ago about the perception, which I think foreigners can be forgiven for jumping to the conclusion that this is really not so much about national security, or it may be about national security, but it's equally about keeping foreigners out of Japanese C-suites or having influence over Japanese C-suites. And that's because of what you mentioned, the focus on voting shares and the focus on nominating or supporting proposed directors to companies. Can you fight back with me? Would you agree with me, or you want to fight back? I'm afraid we can't hear you, Nels.
Can you hear me now? Sorry, I think I went back and forth on the mute. So I think that ascribing a goal to legislation is always risky business. There are a diverse array of stakeholders involved in the legislative process in Japan and anywhere else for that matter. The amendments to FEFTA were publicly described by various government bureaucrats as being intended to address national security concerns without specifying any countries as the target of those concerns. As relevant to governance in Japan, one rumor that spread rapidly among securities firms, Japanese domestic securities firms at the time of the FEFTA amendments, was that a certain Japanese listed company CEO had made a call to a certain high-ranking politician after the 2019 AGM season and requested that he do something about it. I'm not naming any names here. This is just a rumor that many people have independently relayed to me. I don't know if it's true or not.
To email me, I'll tell you who it is.
And so this rumor relates to the reduction in the voting threshold from 10% to 1% and the expansion of the definition of foreign investment I outlined a short while ago. Now, I think like any government process in any country, there's a lot of chefs in the kitchen, and the end result is the product of requests by various constituencies. However, on the definition of foreign investment, expanding that to include a 1% to 9.99% shareholders' decision on how to vote their own shares, I haven't heard a cogent explanation that provides a national security justification for this. It's worth noting that in Martin's remarks, he mentioned that Firma said you can't have control except for voting your shares. In this new regulation in Japan, it's the voting of the shares that's the issue. And so that's an interesting contrast when we talk about, Alicia, you mentioned that perhaps some of these changes were motivated by a request from the US government. It seems like the outcome is different. And so I'm interested to understand an explanation other than that, perhaps, let me just, I have something, I want to be very precise in what I say here. The explanation that perhaps these particular changes were targeting shareholder activists who aim to achieve certain ends, specifically nominating themselves to the board or breaking up a conglomerate, that would explain to some extent these changes. Whether or not they're effective is another question, but certainly ascribing that motive to it seems to make a certain degree of sense. And I'm not aware of another powerful explanation that offers a reasonable logical grounds for this particular change. But that said, the direct impact on activism in Japan is, in our view, unlikely to be material in the near term, because activist campaigns in Japan are predominantly related to balance sheet issues, and balance sheet proposals are not subject to this because you're asking for increased dividend, you're asking for a buyback. None of that is subject to the definition of foreign investment, and the new exemption regime actually helps balance sheet activists because they don't have to worry about what they're doing as long as they stick to that. And so, activism as a whole probably not affected, but perhaps certain types of activism may have been a target of some of these changes. I think that's really all that we can say at this point.
Yeah, thank you for that. And thank you for handling it so diplomatically. Japan is the place that I know most about, so I'm not harping on Japan. And maybe I can ask Martin to comment on whether this is a problem in the United States. But some of the cases that have come to attention in Japan is the case I think we're both referring to, where there's an investment firm which is considered a Singapore firm, even though all of the owners are Japanese nationals, right? And many of them, in fact, have relatives who work in the Japanese government. And so it's a bit odd concept for these people to be considered foreign investors, I think. And on the other extreme, there's a British firm which is operating in Japan, which only does Japanese yen equities, and only the main client, 99% of its business, is with a Japanese entity. And so again, for this to be considered a foreign entity is a little odd when all of the people working there are Japanese nationals and they're doing Japanese yen equity with a Japanese government entity. It seems a little bit fanciful is all I'm saying. So Martin, perhaps I could ask you to comment on what are the early issues, if any, that have come up in regards to the rollout of Firma. And yeah, if you want to talk a little bit more about this whitelist, because again, my impression was that part of the rush that Japan made to get its own regime out there was that they were aspiring to be part of this whitelist. So if you could handle both of those at the same time, that'd be great.
Sure. So Firma actually only recently finally had all the regulations finalized for. So we haven't really yet seen a lot of the ultimate impact. And one of the interesting, so that there are so many possible issues. I mean, so Silicon Valley is really worried about this because of the change in non-controlling, which you mentioned PE. You know, this could also affect VC quite significantly. Within the definition of sensitive data, you have things like private email communications. So we're talking chats, emails, all of this, location data. When I was looking at trying to understand the impact of this, I thought probably just about any consumer-facing company in Silicon Valley collects the location data of people that use the app. And the threshold is that I'm trying to remember the specifics now. It's something like that you'll eventually have the ambition to have data on something like 10 million people, which is not very much. Because the idea is if you reach some sort of scale, then somebody with security clearances is going to be in there. So, but you kind of have to draw a somewhat convoluted trail from the data to someone who has a security clearance and say that, okay, well, maybe this is going to be used to root out and find somebody who they could like blackmail or get access to their private communications. You would expect that someone with a clearance wouldn't be talking about anything problematic on any of these apps anyway, if they're doing their job effectively. But ultimately, the most difficult period in any of these kind of rules is the beginning of the changes. Because if you were working on CFIUS even 2 or 3 years ago, the dynamics have shifted immensely. So what we've seen in the last little bit is a huge surge in the amount of filings to CFIUS, which one would expect. It was actually far less than I would expect. The pilot program on emerging technologies used this industry classification to determine whether you were in a critical industry, and that was judged accurately to be completely unworkable. Essentially, nobody knew if they were in this industry. If you're a large company, if you have a subsidiary who's in this, it's just totally unworkable. And they ended up receiving something like 100 total declarations under this new mandatory filing regime. So which is just minuscule considering the fact that you have just an immense quantity of transactions going on. So there's a real sense that there's kind of a sort of Damocles over a lot of these deals that, if you actually understand the rules really well, you would say, okay, well, maybe we would, these should comply with it. But they just have no idea. And partially it's because there's this whole class of investors, PE and VC especially, that have just never had to deal with CFIUS before. They don't buy companies and control them. They buy relatively small shares, but they're not passive investments. And if you make them passive investments, then you ruin much of that actually makes a contribution to the corporate governance, where these companies have expertise and they're trying to help them out. Now, on the whitelist issue, I think it's very, I really have no idea why there are only 3 countries on this list. It is the UK, Australia, and Canada. So not even all the Five Eyes are on this list. I would expect that American security allies should be on this list. I mean, obviously the whitelist was created to incentivize or kind of strong arm other countries to adopt CFIUS-like review mechanisms. I do think that it's good for many countries to have these kind of mechanisms in place that create their own sensible balance, hopefully not hijacked by certain interests. It probably doesn't make sense to allow a Russian company to buy up a power plant or a port in Finland or Sweden, for example, because of real national security concerns. But if the government doesn't have any authority to do so, that's a problem. But then if they have to try to cobble something together ad hoc, that's also a problem. So I would expect that under a Biden administration, this whitelist is probably going to get used a lot more than in the past. I also think that what the thinking of CFIUS so far under the Trump administration has been, we need to see a lot of deals and follow them up the chain of beneficial ownership before we create too many exemptions. Because what you don't want is to say, well, France is our friend, and they have an investment security regime. Therefore, we should just whitelist all French businesses. So a Chinese military subsidiary registers a company in France that has not necessarily any clear connection to national security, and then buys a US company from that. So, and they say, well, we don't have to file because we're a French company. Well, not really. So they want to see more of that. And I think what will happen is as CFIUS gets more capability to differentiate and understand the risks and kind of interacts with the intelligence community to figure these things out, there will be more of a targeted approach and more of an ability to exempt more deals. The challenge really here is if you want to get specific, you get really complicated. Like me spending a week trying to figure out who applies and who doesn't to this rule, kind of complicated. That would require a company to rack up an immense quantity of billable hours for lawyers. But if you don't write it to that level of specificity, then you have another problem where you're either way overbroad or there's this big gray area and people don't know what they're doing. So it's a real challenge.
Yeah. So back to Nels. I'm interested in this approach that Japan took, which is contrasts so boldly with the approach that the Americans take, which, as Martin described, it's kind of like you're okay until you're not, and we're not going to tell you who's sensitive. Martin referred to this NAICS classification system, which my understanding is it's a US government statistics kind of thing. It's not even a stock market classification. But in Japan, to me, I don't mean to be flip, but it seems like they've published this list of companies saying, hey, spies, you want to see which companies we really care about? Here it is, right? So can you explain why Japan might have chosen to go this route instead of the way the United States has gone? And I think one of the problems of creating this list and then bringing the threshold down to 1% is it obviously throws up to a lot of false positives, right? You're really catching a lot of fish in a net where you really only want to catch, 2 big ones. Could you react to any of that?
Yeah, happy to, Alicia. So the list came out at a particular time that's worth thinking about, perhaps. So the law was announced, the changes were announced. The financial press and the Japan Stock Exchange were very upset, and a lot of concern was expressed by investors all over the world. And there were a number of changes that were announced after that. And the decision to publish a list of listed companies that are subject to the regime, I believe, if my memory is correct, was one of those changes. And so it might be the case that the list was offered up to try to calm people down and say, hey, you're not going to have to worry about every investment, just some investments.
Yeah.
However,
for a second,
go ahead.
To me, that is a sign, again, that there was at least as much concern about controlling who made investments in Japanese companies, as opposed to whether or not they were investing in whether there's a threat of sensitive technology leaking. It's a real micromanagement approach.
Yeah, I think ascribing agency to a government is always risky, because I don't really think that there's a rational mind behind everything that happens. It's just a product of various stakeholders duking it out. But the list itself, when it came out, it had a majority, 2,102 out of the 3,800 listed companies in Japan included in it. And so I think the risk of having exposed something secret by describing which companies are important is perhaps mitigated by the fact that everyone was included anyway. And so all of the companies are important. And so you haven't really revealed very much. The list was updated a few months later, and it's I believe still a similar percentage. It's like 2,159 out of 3,822 listed companies. So it's quite a broad list.
Like an Upper East Side kindergarten, everybody gets a trophy.
Yeah, everyone's special. Right. Everyone's special.
Well, and the additional companies that were added were mostly in response to the pandemic. If I remember correctly, there were pharma companies and healthcare companies and so on, which was understandable.
Yeah, there was a little bit of a broadening, and there have been a number of broadenings of industry categories that are subject over the years. I want to go back to Martin's point about venture companies. So the same discussion exists in Japan too. I'll tell you, although my firm has one of the top 2 CFIUS practices, I personally am not part of that practice. So I'm just describing investors' reaction. I'm not describing CFIUS anyway. I don't know anything about how that works. I would defer to Martin and the other experts. But when a Chinese investor looks at an investment now, and I do work for a number of Chinese venture funds and private equity funds doing investments all over the world, one of their first questions is there a possibility I would have to make a CFIUS filing? Because if so, I'm not going to bother even looking at the investment. And so talking about unintended consequences, it does mean that it's harder for sort of sensitive companies to raise capital. And that's something that's a real impact, I think. In Japan too, there's the scope of application to non-listed companies is not limited to those over 1%. It's all investments. And so there was similarly a lot of concern in the venture community, which has been addressed to some extent. But the filing system here for just a filing itself is not as bad in terms of manpower involved and cost, but the venture investments here tend to be very small. The check size can be a few $100,000. And a large deal might be $5 million, which in the US would be like, okay, so you're pre-seed, right? You're not even Series A yet, but here it's like, wow, that's a big raise. And so it's a very different environment. And I think the effects may be different based upon that.
Yeah, so let's talk more about unintended consequences. I did want to come back to the discussion about how companies get defined in different sectors, because the US government uses this very strange statistic bureau nomenclature instead of a stock market, for example. In the case of Japan, my understanding is that companies were either allowed to self-certify to say I'm a electronics company, or whether it had to do with the company's charter. But I want to talk about one particular unintended consequence that I think is really important, that I was unaware of, that I read about in something that Martin published, which is that US R&D spending has gone down dramatically, and the spending that we do in America has moved overseas. If you could talk a little bit about that, Martin. Yeah, and if anything can be done to reverse that kind of trend.
Yeah, so I think some of the work that I've cited done by my colleagues has shown just this dramatic expansion in the share of R&D that's done not only outside of the United States, but outside of traditional United States security allies. And that poses a lot of challenges for US policy. I think that's mainly the result of simply a globalized world where you have a lot of excellent talent located outside of the United States. A lot of that is driven by China and India. So although that complicates the US ability to control, who has access to technology, and I think it necessitates a little bit of an adjusted approach where we recognize that we're not going to be able to control like we could in the past, when the Pentagon was one of the main, the Department of Defense of the US was one of the main drivers of technology going forward. Now, they're buying mostly, for the most part, things that are right off the shelf. And that sort of blurs the distinction between what is it a military and what is a civilian, and makes things difficult. But I think one of the things that's really just critically important there is making sure that the US can get access to the best talent, because what this means is that there are plenty of other places where this could get done. So if you put too many barriers up to investing in US companies, they can go to Berlin, they can go to Canada and somewhere else, and make that acquisition there, and infuse capital there, and then begin to compete out American firms that might not have access to that marginal capital. Now, you block all Chinese VC investment into the United States in any sensitive sectors. That's a lot of money, maybe in the grand scheme of things, but for the US venture market, it's still quite small. It's not going to make or break most companies. So, but that still means you have to make sure that you're not casting too wide of a net. So the issue is, if you're trying to get at China, and instead you're putting all sorts of compliance costs in for investments from allies and others, then they'll say, well, let's start up the company somewhere else where we can get access to the investment. So for now, the US is pretty safe because the venture ecosystem is so well developed and so liquid, and the networks are so strong. But one of the things that's interesting in these rules, and CFIUS tried to be careful and not kill the goose that laid the golden eggs by kind of allowing it, say you have Chinese LPs in your fund, that's not a particularly big deal as long as they only see, the financials and that kind of thing. But if you have a Chinese GP, and that's based on a Chinese national GP, then they're not going to be able to do these investments, or they'll be required to file. And essentially, if a company is hot, there is no way that if you have to do a CFIUS filing, you're going to get in that round, because you're going to have to waste the executive's time going back and forth with CFIUS lawyers. You're going to spend tens of thousands of dollars at least on a very simple case to make a declaration to CFIUS. You're going to delay the deal. It takes a while to create the filing, and then you might delay 30 to 45 days, and then you might have an even longer delay if they decide to investigate it. So just it puts really foreign general partners at a big disadvantage. So you think about these rules and say, one of the things that might affect our ability to gain investment is if we don't have enough nationalities that are allowed to do these kind of acquisitions, because there are some really great people that if they can't buy companies in the US, they're going to buy companies somewhere else.
Yeah, so again, following on this topic of unintended consequences, I wanted to engage Martin in a little bit of a question. I'm going to try to push back. I could be completely wrong, but perhaps there's no correlation in these statements I'm about to make, but foreigners have been net sellers of Japanese equities since 2016. So it's before this new regime took place, but you commented that you did not expect shareholder activism to see any decline in Japan, and yet it's true that among small companies, which generally are not of interest to the Japanese government, they're small, older, family-owned companies, are not national security sensitive. That area for shareholder activism is on fire. But when you talk about the older, big conglomerates that are traditionally run Japanese companies and who very likely have operations that do things like nuclear technology or aircraft technology, it seems like the big activists who would normally go after them have kind of given up. And, I consult for one of them. They just say, it's not worth it here anymore. So I wonder if that's an unintended consequence. And then touching on what Martin was just talking about, I was going to ask the question about the disadvantage that foreign investors have in the case of time-sensitive transactions like takeover bids or hostile takeovers or that kind of thing. Do you see any influence of the new law on these kinds of activities?
So Alicia, I would agree that there may be unintended consequences in relation to the type of activism that happens in Japan. So as mentioned, the vast majority of activism here is balance sheet focused because, frankly, there are a lot of companies that have very interesting balance sheets in Japan and are very attractive as a value investment because they may have real estate and cash that exceeds their market capitalization. That's not that unusual here. And so you could simply shut down the business, sell the assets, distribute them, and everyone would make a huge profit. And so because of that kind of opportunity that has vanished for much of the rest of the world over time, there simply is a lot of attraction for balance sheet activists here. But as you point out, the large conglomerates, a lot of private equity firms are interested in them because of the conglomerate discount. And activists naturally in many other markets would be interested in them for the same reason, because the idea would be you get involved in the board, you have a discussion, and you split up the company in a way that makes each part of it more valuable, and that would be a good thing. There isn't as much of a political consensus, I would say, in Japan that would be a good thing, is one thing. And the management of a lot of these companies is not incentivized to break up the company as much. Most companies still don't have stock-related compensation. They get paid a salary. And so that's perhaps another factor. Also, the amount of strategic shareholdings makes it difficult for a shareholder proposal to actually be passed without the support of management. And so I think there are a lot of reasons why, even before this amendment to FEFTA, the large companies were not subject to effective activism in the form of breakup activism like you see a lot in Europe, in the US. But as far as an unintended consequence of this reform, we could see that activists that aren't currently active here are going to be deterred potentially from coming in because they see it as yet another barrier to them doing what they see as ways to create value. Whereas the balance sheet focused activists are like, party on, let's just keep doing what we're doing.
Exactly.
And the result of that may be that the only effective levers on management are balance sheet focused, which may mean that you simply see a lot more of balance sheet activism and less sort of growth focused structural change, breaking up and reforming companies in the way that METI says publicly that they want. And they released a document this summer saying that that's what they want. This sort of it seems to be potentially a consequence that moves things in the opposite direction, at least as far as shareholder activism goes. And so, and that said, if you're an activist that wants to do that kind of thing, it's not that FEFTA has made that impossible, it just made it a little bit more difficult.
Yeah.
And so it's worth noting that you spend a little bit of time preparing for this. You can make a filing and have it be effective for 6 months in advance with respect to acquisitions. So you make your filing. If you can't get the voting rights right away because FEFTA would require pre-notification to have gone through first, you can do things with derivatives to acquire the economic position. And as long as there isn't a record date for a shareholder meeting during the time when you're dealing with FEFTA, there shouldn't be a material impact on your investment. And so if you do it properly, I would posit that one of these more aggressive or more breakup type of activists absolutely could run their campaign here, but the other obstacles to their campaign remain, namely that a lot of people here simply aren't interested in doing that sort of thing.
Right. I mean, that's an interesting point I hadn't thought about, which is that the consequences of FEFTA might push more balance sheet activism. And in my view, that would be a shame because it's going to rekindle this idea in Japan that activists are just asset strippers and they're just there for the short term to take our money and leave. And, that's not really what it's about. And that would be a shame if that sort of attitude returned and those TV dramas returned about horrible activists and so on and so forth. I want to ask you to react to something that Martin talked about, which Martin was talking about the remedies that the government has when acquisitions are made and are found to be contrary to national security interests, or even when they're given approval and later found to have problems. Can you speak about what the situation in Japan is? I mean, I'm aware that they have the legal power to force divestment, but that's never been used as far as I know.
Right, and maybe it relates to the fact that Martin pointed out that the FEFTA regime has not been a mandatory filing regime, and in Japan has been more of a mandatory filing regime. And so there perhaps are simply less circumstances where people accidentally sort of went ahead and did it. That's just speculation on my part. But if you violate the FEFTA, first you're put in the penalty box permanently. So there's this new exemption system I mentioned earlier, and you're not eligible to benefit from the exemption system if you've got a FEFTA violation in your record. And so if you're the type of investor that, as is more and more the case, you're a traditional asset manager making traditional public company investments, and every once in a while, more and more every year, you're starting to do things that are a little bit activist-ish. You're not an activist, but you're Fidelity or you're someone like that who's a huge financial institution, and there's just a situation where you feel compelled to do something. Well, if in doing that you violate FEFTA, all of a sudden you have a huge problem. And so you really don't want to get into that kind of a trouble. On top of that, there are some financial and criminal penalties associated with it. And so you really just don't want to get involved with violating FEFTA, in addition to the possibility of the transaction being unwound. So that's at a high level what I'm prepared to say about that.
Yeah, but again, I'll ask you both this question. I mean, take the hypothetical that, well, we almost have that in Kirin. Let's take the case of Kirin. So they're a beer company. So they're vital national security interest because everybody likes to get drunk, right? But once they start a biotech division, so I acquire 30% of Kirin or 40% of Kirin, because I'm Judge Kavanaugh, I'm joking. And Kirin suddenly starts a biotech division or a facial recognition division. What happens to me as a foreigner, my investment in Kirin? And I'm going to ask Nels Martin the same question in a minute.
Okay. So we look at the subject actions for the FEFTA regime. One action is an investment, so an additional purchase of shares would trigger a filing obligation if you're above the 1% threshold. But selling, presumably is not an issue. You couldn't vote your shares on a proposal to put yourself on the board potentially without making a filing. But again, it's not a prohibition on further investment or prohibition on voting your shares. It's simply that you have to make a filing if you wish to do so.
Yeah, but what if
And
I'm just
so,
sitting there casually? I'm not going to increase my investment and I'm not going to sell. I'm just sitting there. And suddenly, unbeknownst to me, or I suddenly realize that Kieran is starting a national security sensitive kind of business. What action or what do I need to be afraid of?
So I suppose you need to just make sure that you don't buy
Vote.
any more shares or vote your shares for yourself to be on the board in the circumstances where you haven't yet made a filing and had that action be approved.
Right. And so Martin, in the case of the United States, again, if I am buying I don't know, Barnes and Noble, a book company, and after that transaction is cleared, Barnes and Noble comes up with some invisible ink or something, I don't know what, would that trigger a review? And what would happen then?
No, you wouldn't have any review in that case. If you were, say, a passive investor in Barnes and Noble, and then they went into a national security sensitive sector, and then you decided to up your shareholding and make it non-passive or start to nominate board members to if it was deemed to be critical technology, then that would be involved. But generally, the view is if you're going to do greenfield investment and start from scratch, CFIUS has nothing to say about that transaction.
Right.
And if you already made an investment and if you got the safe harbor from CFIUS, it's okay. Now, one interesting case for this question is Musical.ly / ByteDance TikTok, which is the #1 CFIUS case that everybody's been talking about. And there, I think it's a pretty interesting case because when they bought this thing, it was only a few teenagers in the US really used this to lip sync. And if you'd make the case that there's a national security concern if Xi Jinping knows that your teenage daughter likes to sync to Beyonce videos and not Jay-Z videos, I don't buy that as a thing. So it may well be that investing in that company, that specific company at that time, may have gone through CFIUS just fine. But then once, because they didn't file, and then later on it became this massive thing where people are organizing activism, and many people on military bases are using this, and it turns out that it's able to kind of listen to you whenever. I mean, our phones are always listening and tracking our location and things. Then you can pretty easily make the case that there's some national security concern, maybe not necessarily saying we absolutely need to divest, but to put some mitigation on that. Those concerns came out later, and was due to mainly a change in the way that the way it was absorbed into ByteDance. So that's just a signal that it can change, but you're kind of better off filing if you think that it might go in that direction. And it's surprising a bit to me. I don't know who their lawyers were on that acquisition, but it's surprising to me that that no one thought of that. Maybe they were just thinking, they're Silicon Valley types that usually didn't deal with CFIUS at all.
Yeah, I guess my question is simply, derived from the observation, I was a security analyst, and companies change every day. Companies change the focus of what they're doing every day. And so just because I'm okay with CFIUS or the Ministry of Trade and Industry in Japan today, how do I know that I'm going to be okay tomorrow? I do want to move on. We have 3 questions. One of them is from my student, so I'm going to ask that one first, which is for Martin, which is, the question is about the transparency of CFIUS reviews, and the degree to which CFIUS should or should not become a little bit more transparent. What criteria are there to help draw the line of rational security risk? How can we be sure that this is a national security issue? I mean, the case of TikTok is a case in point, right? It's like the reason that a certain person's eyeballs went there was not really because of national security. So CFIUS has become a little bit more transparent, right? We have annual reviews that we haven't had for a while. Could you answer that question?
Yeah, so they do put out, how many cases they reviewed, how many went to investigation, how many decision was made. They don't tell you anything about how many of either deals were discouraged without even bothering to file, because like Nels said, Chinese investors are not even bothering to file. They don't tell you how many people came into CFIUS and CFIUS said, don't bother because there's no way we're going to let that transaction go through. So it's a very incomplete picture. They would argue that if they had to disclose who had filed and that would immediately politicize it. Everyone would be trawling that list in Washington, kind of ready to pounce. So the cases that get really messy are the ones often in which someone who was also trying to bid on that company got outbid by a foreigner. And then they decide to drum up, hire a bunch of lobbyists to go into Congress and say, if these guys buy this, then it's going to be a really big deal. And sometimes it's like literally a British company that ends up buying it instead of a French company. And they try to argue that selling it to the French is going to lead to some national security crisis. It's pretty bad. So I don't know exactly where I stand on this. I think that there's definitely, my view is when CFIUS was relatively small and the borders were sort of clear cut, you're not going to let someone buy a missile company, that kind of thing. When the bright lines are clear, it's fine to be pretty opaque. And but now that it's expanding into everything and data and critical technologies and all this, I don't think that level of opacity is tenable anymore. I think it leads to too much ambiguity and too much reliance on private information that lawyers have, which is changing really quickly and is extremely expensive expertise. So, and makes it hard for people like me who observe this process to try and get a sense of what's happening. You have to rely on contacts and all this. So I think we need to move in the direction of more reports, because there are reports now, they tell you by country, but then they tell you by industry, and that the industry calc doesn't really give you any useful. They're like, okay, here's how many in manufacturing and here's how many in finance and real estate. Okay, that doesn't tell me anything.
Yeah, Nels, if I could ask you the same kind of question about the secrecy of the outcomes in Japan, is that something that needs to be addressed? Is it good the way it is? Do you see any need or demand for change in that?
Yeah, so I would say that overall Japan has not had as many cases become in the public eye. And I think in part that's because things have tended to get approved, at least historically. And the government has publicly said they're going to be doing this solely based upon national security criteria. The way that the process works is you go in through the Bank of Japan. They then connect you with the relevant ministries. They basically ask the relevant ministries, do you care about this company? Is it a real thing? That ministry may feel that it needs to reach out to the relevant company, or they may not feel that need, in which case, if they do feel that need, they'll ask the investor for permission, usually, to say, hey, do you have a problem with us reaching out, and who's your contact there if you're in touch with them?
Yeah.
And so that in the course of that process that's newly reinvigorated because of this reduction in the threshold from 10% to 1%, it's possible that someone would give up and say, if it's going to be like that, I just don't want to bother. And that would move things more like they are, I think, in the US. But the overall cost of the process is still a lot lower than it is in the US, I would say. The chances of it becoming a huge, public fight are relatively lower. That's just a sense. You could look at it from the number of instances in which the government has raised an issue publicly, but it's not always possible to capture all that. It's just a problem, like Martin put out. Yeah.
The flip side is that a number of AGMs in Japan have gone just smooth as silk, even for sensitive companies. I have just 1 minute left. So I first of all want to say there's 2 other questions we didn't get to, and I will email those people and try to collect answers from Nels and Martin and get them back to those people who asked. Secondly, I just want to wind up and say thank you very much to Nels and Martin. I really appreciate it. I think this is a fascinating topic because we live in a global world and companies have global supply chains, and there's very little we can do to change that. And I think it's an issue that does have a lot of unintended consequences that we're just beginning to feel. So thank you both very much. And now it just remains for me to thank our sponsors, and thanks to the CJEB staff for the support for this event, and thank you all for attending. Are welcome to view the replay of this event when it becomes available, and we'll look forward to seeing you again at another one of our events soon. Thank you very much.